Hello, welcome to this video on what it takes to qualify for the marital deduction. The marital deduction is provided by Section 2056, and we are going to focus on the concepts as it relates to the marital deduction. I want to make sure that that's clear, and we're not going to go through a number of illustrations. We will be talking conceptually. Understand that the marital deduction is not a real deduction in that it provides for a non-taxable gift given to a spouse. This is all keeping with the congressional purpose of keeping one economic unit between spouses. However, once the property leaves the marital unit, there will be some type of tax. Section 2523, relating to gift taxes to a spouse, is similar to 2056, but 2523 deals with inter vivos transfers, while 2056 deals with testamentary transfers, and the rules are essentially the same. Most often, the marital gift occurs at death, which is the focus of this video. We will talk about what it takes to qualify for the marital deduction, and we'll pick up in another forum the form of the marital deduction and the amount of the marital gift. So qualifying for marital deductions, in order to qualify for the estate tax marital deduction relating to transfers to the spouse, Section 2056 requires that the following conditions be satisfied, and it's these 6 conditions. Condition 1, the decedent must have been a U.S. citizen or permanent resident. This means that the government is basically recognizing that if you're a U.S. citizen or resident, you are subject to tax. If you are not a U.S. citizen, you are not subject to tax, generally. It's as simple as that for this particular Item 1 condition. With respect to Condition 2, a spouse must survive the decedent. A common disaster would be an exception, and the spouse that survives you is a matter of state law for the purpose of this condition. For example, some jurisdictions recognize common law marriage. If it's established that you have common law marriage by state law, then you're considered married. Also, there's the issue of same-sex marriages and how the marriage is recognized for state purposes. If you're a domestic partner and not married under the state law, then the partner is not considered a spouse for the purposes of this particular condition. With respect to Condition 3, where it says the surviving spouse must be a U.S. citizen, this is not quite as simple as it looks. It's Section 2056D that denies the deductions if the spouse is a non-citizen. However, Section 2056A provides for a deduction for non-citizen spouses if the requirements for a qualified domestic trust are met, and that's called QDOT. When the conditions are met, the property included in the qualified domestic trust will be subject to estate tax. At the death of the non-citizen surviving spouse, in the estate of the decedent spouse, not the estate of the surviving spouse. I should repeat that. So what occurs here is if the conditions are met with the QDOT, the property included in the qualified domestic trust will be subject to estate tax at the death of the non-citizen surviving spouse, but it's included in the estate of the decedent spouse, not the estate of the surviving spouse. I want you to get that. So the QDOT serves only to defer the tax due on the assets passing to that trust until the surviving spouse dies. At the death of the surviving spouse, what we end up doing is recalculating the estate, the tax that's in the estate of the decedent, by adding the value of that property that was in the QDOT to the decedent's gross estate, redetermining the estate tax using the law that applied at the time of the decedent's death, then comparing the recalculated estate tax to the actual estate tax. Then, whatever the difference is, that's going to represent the amount of tax that's to be paid. That means that this may not be so good of a thing. Be careful because it's a deferral, it's not a real deduction. So, make sure you get that. This is not as simple as it sounds. There's some exceptions, and if you use the QDOT, it's a deferral of the tax. It's not going to necessarily end up being something that will be a permanent deduction. With respect to condition 5, it reads, the property interests passing to the surviving spouse must be included in the decedent's estate. So think about this provision this way. Sometimes we have clients who are looking for a refund when there was nothing paid over to the government, assuming they didn't qualify for refundable credits. If they didn't have withholding or pay estimated taxes, there's nothing to refund. Well, this provision is similar in that there's no deduction allowed if the value of the assets that relate to the deduction was never included in the decedent's gross estate. So if we say that the decedent, for example, made a gift to the spouse of the remainder interest, then relinquished the life estate more than 3 years before death, more than 3 years before the date of death, then there's nothing that's going to get pulled back into the decedent's gross estate. Since there's nothing pulled back into the estate because the pullback code sections do not apply, although the property interest passed to the surviving spouse, there's no marital deduction because there's no tax relating to the property that passed to the spouse. So this could be tricky. You just want to make sure that you follow the two sides of the coin here. And one is that not only do you need to look at whether or not the property passes to the surviving spouse, you need to also make sure that it's included in the decedent's gross estate, that it must be included in the decedent's gross estate. And finally, condition 6, the property interest passing to the surviving spouse cannot be a non-deductible terminable interest. This is applied what they call the terminable interest rule, and it's found in Code Section 2056B. This statute can be somewhat complex. It's basically, when you're looking at the interest that's passing to the spouse is where the problem rises, not the terminal interest that passes to someone other than the spouse. It means that the interest that is to be received will lapse or fail upon the occurrence or non-occurrence of some event. That could be that you get an interest for life, then you die, and the remainder goes to someone else. That is called an interest that failed upon the occurrence of an event, that event being death. It could also be a situation where you get the use of the property until you marry, and then it goes to someone else. Well, the occurrence of the event is the remarriage. So there's two ways to have a non-deductible terminable interest. One is if the executor acquires a terminable interest for the surviving spouse at the direction of the decedent, Or the second is if the interest in the property passes to the spouse and an interest in the same property passes to someone other than the spouse, and that other person only enjoys their interest in the property when the spouse's interest terminates. In these two ways, you have a non-deductible terminable interest. And that's it for our discussion on pulling together the conceptual concepts relating to the requirements to qualify for a marital deduction.